So a number of people were none too pleased to see me give the gold medal award in my most recent video about the top covered call dividend ETFs for 2023 to JP Morgan's JEPI, primarily due to the fact that JEPI has only been in existence now since May of 2020. The cry was unanimous for DIVO, the Amplify CWP Enhanced Dividend Income ETF. For the record, I stand by my decision, but at the same time, a deep and thorough review of DIVO is also warranted. In doing this review, I also had a very shocking epiphany, which I want to share with you, so make sure to stick around to the end of the video. Here is absolutely everything you need to know about the dividend ETF, JEPI. I mean, DIVO, dang it, I did it again. Okay, so let's start with the basics with DIVO. First off, it's an actively managed ETF of high quality, large cap companies with a history of dividend growth. And with that, they utilize a tactical covered call strategy on individual stocks. So a few points here. Number one, actively managed. Instead of sticking with a specific index and rebalancing over time to stick with that index, instead we are handing over the decisions on which investments are in the portfolio to an investment company. They make all the decisions and they can change part of or the entire portfolio if they feel it's warranted. One of the unique things about DIVO that we don't see with really any other dividend ETFs is the small concentration of dividend stocks. Right here, only 30 holdings in the portfolio, and we are going to do a deep dive here to see what investments are actually in the portfolio. The expense ratio here is a little bit elevated at 0.55%, meaning for every $10,000 invested, your annual fee would be about $55. DIVO pays dividends or distributions on a monthly basis, and their current distribution rate is 4.83%. Their 30-day SEC yield is 1.82%. Now you might be thinking to yourself, what is the difference between 30-day SEC yield and distribution rate? Because these are drastically different numbers. This number right here is based on dividend income alone from the underlying assets in the portfolio, whereas the distribution rate incorporates both dividend income as well as option premiums earned by selling covered calls. Here is DIVO's specific selection methodology. Step one, focus on dividend growers. They have a strong emphasis, as it says here, on owning high quality, large cap companies with historical dividend and earnings growth. So it's not enough for them to just pick dividend stocks that have a history of raising their dividend. They also want to see companies that have consistent earnings growth as well. They're balanced on their sector allocation among the traditional 10 S&P sectors, and their security selection, aka stock selection, consists of 20 to 25 stocks which are screened and adjusted according to attributes which include their market capitalization, the management track record, earnings, cash flow, and return on equity. And then they write covered calls on individual stocks on a tactical basis. In other words, there's not a set criteria and methodology they use. They reserve the right as an actively managed fund to say, you know what, we're going to write calls in this specific scenario this month. And as we see changes in the market, as we forecast different things happening, we're going to adjust our strategy along the way. So it is proprietary in nature. They do share with you, we will look at their current options in the portfolio, but how they do it moving forward is not shared with you publicly. DIVO also provides very explicit tax information with respect to their distributions. This is their 2022 year-end tax reporting information. If we go down to DIVO, we can see that total distributions were just over $1.70 per share. And you'll notice over here in box 1B that the majority of their dividends are qualified dividends. All right, here's DIVO's current holdings as of January 20th, 2023. Their top holding is actually Visa right now, 5.35% of the portfolio, followed by Chevron, McDonald's, Home Depot, United Health Group, Merck & Company, Procter & Gamble, Johnson & Johnson, Microsoft, Goldman Sachs, JP Morgan Chase, Devon Energy, Amgen, General Mills. They're holding a little bit of T-bills here, 1 to 3 month treasury bills. Nucor Corporation, Deere & Company, Schlumberger, that's a company I've never heard of, Schlumberger Limited, Lockheed Martin, Duke Energy, Verizon Communications, Apple, and then Dow Incorporated. And then you can see right here at the bottom, a very clear and transparent view on their options currently in the portfolio. They've got covered calls with United Health, Duke, General Mills, Apple, Microsoft, and Dow. And based on this information here, it does appear that they write these options on a monthly basis. So what I really wanted to do when looking at these holdings, since there was only 25 to 30 of them, I think there's extra value in looking at these specific stocks that they think are valuable in holding in the portfolio and see, well, how do they align with the type of stocks that we talk about here on the channel, on the Average Joe Investor channel, and specifically in the monthly dividend stock spreadsheet, which I share with my Patreon community and the Discord chat, which, by the way, if you want to learn more about that, check out the link in the description below. But how do these individual stocks stack up? So you can download the entire list of holdings for DIVO right here as a CSV file, which is an Excel file. And when you do, you'll get this view right here. But I felt like this was just not enough data, and I wanted to really splice out which of these stocks were dividend, aristocrats, dividend kings, what were their dividend growth rates, specifically their current dividend yields. So I decided to filter in some of the data from my monthly dividend stock spreadsheet. And voila, this is what we're left with here. So we've got all the same holdings for DIVO, filtered with some additional information from my spreadsheet. You'll notice here they do have a few dividend kings and dividend aristocrats. We've got Johnson & Johnson and Procter & Gamble, solid companies with over 60 years of dividend increases. We have a few dividend aristocrats, including McDonald's, Chevron, and Nucor Corporation right here, along with quite a few contenders. And when I say a dividend contender, I mean companies that have been raising their dividend every year for at least 10 years, but less than 25 years. Now, I did find a few things interesting. I do wonder why they have Chevron in the portfolio instead of ExxonMobil. I actually own Exxon in my own portfolio, and I'm just a little bit caught off guard because ExxonMobil definitely has a higher dividend yield and definitely a richer option premium. I also found it interesting there were a few stocks in this portfolio that didn't really seem to meet the criteria for DIVO. Right here, we've got General Mills, Deere & Company, and Schlumberger, I think is how you say it. We had 3 years of consecutive increases here for General Mills, which I would not call a consistent dividend grower. Then we've got 2 years for Deere & Company and only 1 year for Schlumberger. And then down here with Dow Incorporated, they don't raise their dividend at all currently. It has been steady at 70 cents quarterly for a few years. Now, that's not to say that these are bad stocks to own in a portfolio. I'm just trying to figure out here why these specific companies are in a portfolio in which they state that their main objective is to invest in dividend growers. You've got dividend yields in this portfolio ranging from as high as 6.3% for Verizon, 4.93% for Dow, 3.2% here, and as low as 0.5, 0.6, 0.7%. And we've got our covered calls here that are existing right now in the portfolio: United Health Group, Microsoft, Devon Energy, General Mills, Duke Energy, Apple, and Dow. Now, the majority of these options are actually set to expire today and be assigned on Monday potentially. So it'll be interesting to see what happens with those and to see what the portfolio looks like for DIVO on Monday or Tuesday of next week. But in the meantime, I looked at these two right here: Microsoft, which expires in a month on February 23rd, and the same with Apple, February 23rd. And I looked at the actual option chain and noticed that for Apple, the 146 strike, at least based on today's information, was actually a delta of 0.24, which is, I would say, semi-aggressive, not completely. And then for Microsoft, we have a much more conservative play, only a 0.12 delta as of January 19th when I looked at this. Here's a look at DIVO's price movements over their history compared to their dividend payments. One of the great things about DIVO is that they have really strong capital appreciation balanced with really strong dividend income. And you can see that the price started right around $25 back in 2016 and has risen now to over $35 per share. When it comes to covered call ETFs, this is the exception to the rule. We see a lot of with Global X and other funds where they are hemorrhaging capital value. They're going down and down. Their share price continues to go down. And while they might have excellent income, we wonder about the sustainability of the fund. This is not a problem with DIVO. They do an excellent job of managing and balancing their price per share and seeing that it goes up on a continuous basis. And they have really strong dividend income. Here's their price compared to their monthly dividend payments. Don't pay too much attention to this right here. This was because DIVO in the very beginning was paying quarterly dividends, and then after about a year and a half, they transitioned to monthly. So relatively stable, as low as what, 0.4, 0.115 actually right here, and as high as maybe 0.16, 0.17 for distributions, but otherwise very stable. So let's take a look at a hypothetical scenario. Let's say you had $250,000 and you had a lump sum investment that you were looking to retire on, trying to be a little bit more specific and modeling an actual portfolio that you have that you want to live on just the distributions if possible. So $250,000 lump sum investment back in December of 2016 when this fund launched, and then not adding any new money to the portfolio and not reinvesting dividends. And then we'll compare to actually reinvesting the dividends for that time frame to see what the difference in the portfolio looks like. So here's what that portfolio would look like, assuming starting with $250,000. Orange is if we were reinvesting dividends, where the blue is if we were just living on the assets and not reinvesting or adding new money. And you'll notice that in the beginning here for the first couple of years, there's not much of a difference, but then we really see after the COVID drop here in March of 2020, a really big difference between just living on the assets and reinvesting the dividends, which is what we should always expect. But despite that, even if we're living on the assets, we jump from our $250,000 initial value to down to $216,000. But from there, we actually increased and popped up the value up to $380,000, and we currently have a portfolio of over $357,000. And then this graph down here shows the difference between dividend income if we were not reinvesting dividends, that's the blue line, versus if we were reinvesting our dividend every single time we received it, and how that would change our overall dividend income for the entire period. Which it does make a big difference. If we reinvest those dividends, by the end of the period, we'd only have $100,000 in distributions versus a much higher amount now here of $119,000. So some of the good things I see with DIVO. Number one, they have excellent investment results over the time frame we have available. The fact that they write covered calls leads to less volatility, especially in declining markets, and provides a good amount of income in combination with the dividends from the underlying assets and the option premium from selling covered calls. However, in my opinion, not everything was perfect when looking at DIVO. Number one, I noticed there was quite a bit of cash in the portfolio. You'll notice here $199 million in cash, which is nearly 8% of the portfolio just sitting there. And DIVO does not explain anywhere on their website why they have $200 million in cash sitting on the sidelines, except for maybe just making a logical conclusion. We've been experiencing a declining market, and perhaps they're just wanting to have cash set aside so that they can be proactive and jump into deals if the market crashes. Otherwise, this is just wasted opportunity and money that could be invested and generating additional covered call option premium. Now, the other thing I don't quite like about DIVO that I think is an opportunity for them to improve is their dividend income is not growing on a year-over-year basis. Yes, the underlying stocks that they own are increasing their dividend every single year, but the actual distributions coming out of DIVO are not. We can see here this graph showing that the cumulative dividend income growing steadily over time, but if you look at the actual distributions, they really are not growing consistently. We're bouncing around here, up, then down, then up, then down, then up, then down. It's kind of all over the place, and it is not a consistent grower of the dividend. So for me personally, what I found very fascinating as I was thinking about what DIVO does and how it's so unique in the dividend ETF space. Usually you would look at like SCHD and VYM and VIG and a lot of these other dividend ETFs. We see a lot more diversification. But with DIVO, we see a very concentrated portfolio of dividend stocks. And I was thinking to myself, that's a lot like what I do, right? I've only got 10 to 15 stocks in my own portfolio that I write covered calls on. I'm just a little bit more aggressive with my portfolio. Number one, I'm writing covered calls on every single investment in the portfolio, as opposed to just a few of them, which is what DIVO does. And I also focus exclusively on dividend stocks that meet my dividend criteria, raising their dividend for at least 5 consecutive years minimum, though I like to shoot for 10 to 25 to up to 50 years, and looking at consistent, good, strong dividend growth rates. Now, looking at what DIVO does in their own portfolio, notice that the majority of their stocks do have good dividend growth rates, and a lot of them are actually outpacing even our current crazy inflation rates. There were a few stocks, though, that didn't have great dividend growth rates, including Verizon and Duke Energy, very consistent here, right around in the 2s. And then, of course, Dow doesn't actually grow their dividends, so of course that one is a little bit unique. And again, with SLB and DE just not having a long dividend history. I also focus on dividend stocks with a much higher yield than a lot of them in the portfolio. Some of the stocks I own do have a yield of 2 or 3%, and I look to supplement that with actual covered call option premium, but a lot of the stocks in DIVO's portfolio are definitely in the 1 and 2 range and being supplemented with covered calls. The way I'd like to characterize DIVO's investment strategy is it's a more mature version of my own portfolio. About the same number of stocks, maybe just a few more, and generating a lot less option premium than I do in my own portfolio. But then again, when I think to myself, if I had $2 million in a portfolio, would I be writing covered calls on every single one of the investments, or would I be more conservative and be generating just enough cash that I need and then making sure that all the rest is capital appreciation and growth in the investment portfolio? DIVO has shown great results, but I get more cash flow and I have a more steady portfolio balance over the past year and a half, 2 years than DIVO. Make sure to leave your 2 cents down in the comments below. I respond to all comments that I receive on the day I post a new video. That's all I got for you guys in this video. Have a great rest of your day and thanks for watching.